All right, welcome to this explainer. Today, we're diving into a genuinely fascinating financial concept, one that basically acts like a high-end suspension system for your investments. If you've ever felt, a bit financially seasick from the relentless ups and downs of the global markets, well, you are absolutely in the right place. Let's look at a vehicle specifically designed for steady, stress-free, long-term wealth building.
So, let's kick things off by acknowledging a very real, very common hurdle. Are stock market swings taking an emotional toll on you? Because honestly, it is completely normal to feel your anxiety spike when the market gets unpredictable. I mean, you work incredibly hard for your capital. Logging into your account just to see massive, glaring red drops, that's exhausting. And worse, that emotional toll often pushes us into making some pretty poor financial decisions.
To combat that exact anxiety, our sources point us straight toward a very specific solution: the Low Volatility ETF. Now, as the definition points out, this is a fund intentionally focused on stocks with much lower price fluctuations. It's actually governed by this brilliant little philosophy: follow the rise, resist the fall. It's not out there trying to win every single sprint. Instead, it's built to survive the bumps and just keep you safely on the road.
Okay, here is our quick roadmap for today. Number 1, the market shock absorber. 2, how the filter works. 3, the math of losing less. 4, who should be investing. And finally, number 5, trade-offs and caveats.
Let's jump right into Section 1, the market shock absorber, protecting your portfolio from the crash.
Notice this specific maxim: follow the rise, resist the fall. This is basically the ultimate shock absorber for your wealth. See, the goal isn't to just ignore market growth. Obviously, you still want to capture that upward momentum. But the true magic actually happens when the market takes a sharp dive. This asset class is quite literally engineered to resist that downward gravity.
Moving right along to Section 2, how the filter works. Let's look under the hood.
So how does an ETF actually achieve this gravity resistance? Well, it's not magic. It's pure, methodical data science. The underlying strategy relies on mathematical models known as volatility weighting or minimum variance. Now, in plain English, that really just means the fund is actively seeking out companies with rock-solid recession-resistant operations. Instead of just weighting a stock by how big the company is, these models are hunting for businesses with incredibly predictable cash flows entirely regardless of what the broader economy is doing. And that brings us to the exact safe haven sectors making up that filtered pool. You see, we aren't looking at wild, volatile tech startups here. We are looking at utilities, consumer staples, the basic daily goods people have to buy even during a deep recession, and well-established financials. Because these sectors enjoy practically unbroken revenue streams, they simply don't experience those massive, heart-stopping price swings that cause investors to panic.
All right, let's get into Section 3, the math of losing less and exactly why downside protection matters so much.
The whole strategy really comes down to this one crucial point. Imagine you start with $100. If you hit a brutal bear market and suffer a 50% drop, well, you're down to $50. Now, to get back to your original 100, you don't just need a 50% gain. You need a staggering 100% gain just to break even. It's crazy, right? But if your shock absorbers limit that initial drop to just 20%, you only need a 25% gain to fully recover. Mathematically speaking, projecting your downside is just vastly more efficient.
And those staggering recovery percentages prove a very famous investing adage completely right. Losing less is winning. In the financial world, having a strong defense is literally just as critical as your offense.
But hey, the benefit isn't just about the math. It's deeply, deeply psychological. When you control the fall, you keep your confidence intact. You aren't mashing the panic sell button at the absolute bottom of a bear market, just out of pure fear. By holding on calmly, you allow the incredible snowballing power of compound interest to actually work in your favor over the long haul.
Okay, Section 4. Who should be investing? Let's identify the ideal passengers.
Let's connect this directly to you. Who benefits most here? Well, if you fit into one of these categories, this tool is practically custom built for you. It's an absolute game changer for retirees who rely on steady dividends and just cannot afford massive drops. It's also incredibly valuable for busy professionals who do not want the constant stress of micromanaging a wildly fluctuating portfolio. And naturally, it's a no-brainer for any risk-averse investor who just wants to sleep well at night.
Now keep in mind, you don't have to choose just one single strategy. A super effective approach is actually using a low volatility ETF as your central stable core. With that firm anchor in place protecting your downside, you can safely sprinkle in some growth or tech-focused ETFs around it. That way, you get a little taste of that rapid growth, all while keeping your defensive foundation completely rock solid.
Let's wrap things up with Section 5, Trade-offs and Caveats, or what I like to call the speed limits of the strategy.
Because let's be real, no financial tool is totally perfect. The most vital trade-off you need to know is this. The exact same mechanism that heavily shields you during a market crash is absolutely going to hold you back during a massive, roaring market rally. Because these funds intentionally exclude fast-growing, highly volatile stocks, a low-volatility ETF will very often lag behind broader market gains during a bull market. You are actively trading away maximum top-end speed in exchange for maximum safety.
Furthermore, you've still got to stay vigilant. Because of how this filter works, there's always a risk the fund becomes overly concentrated in just a handful of conservative sectors. If new, heavy regulations suddenly hit the utility sector, for example, your fund is definitely going to feel it. Plus, since these funds actively rebalance their holdings, you absolutely must keep an eye on internal costs and management fees so they don't quietly eat away at all your hard-earned returns. So, bringing it all together, we can clearly see the distinct role these funds play. In a financial era entirely defined by unpredictable market turbulence, low-volatility ETFs serve as the essential mechanical suspension system for your long-term wealth. They let you stay comfortably in the driver's seat, riding out the worst bumps while securely protecting your capital.
And with that, I'm going to leave you with this final thought to evaluate your own readiness. Take a look at your investments today. Are you driving down a rough road without a suspension system, or is your portfolio already equipped with a proper shock absorber for whatever the market decides to do next? Thank you so much for joining us for this explainer, and as always, happy and safe investing.